and welcome back to the MCR Accounting Financial Literacy Series. Today we're going to do the last in our big T-slip series that we began, you may remember, with the T-2200. We talked about the T-2242 for northern residencies, and we've talked about the T-2025 proprietorship businesses. The order that we've done these in, they've been building more and more towards the need for accounting and bookkeeping as opposed to just good quality record keeping. And as we come now into the 2042 Statement of Farming Activities, that is going to be the key point. The secret to being able to properly defend your rightful tax profile as a Canadian farmer will be, just like in previous episodes, heavily related to the quality of your bookkeeping, your record keeping. And we're going to start calling it bookkeeping now, because we're past the point where, you know, keeping neat receipts in file folders is really what we're looking for anymore. And this, any kind of a significantly operating farm, I feel, well, like many businesses, you should be looking at a daily bookkeeping task. If you really want to make it easy for yourself, you do these things on a daily basis. At the very least, you do weekly basis. And then at the 2025 and 2042 level, there's scarce difference between the best practice approach that you would need to follow as opposed to what a limited company needs to follow. And that's a long-winded way of saying, bookkeep your stuff daily, do a weekly review, make sure your bank and everything is up to date weekly, but do a formal month-end review regularly, religiously. The easiest way to keep your books in order and to keep your banks reconciled is to approach it with absolute regularity and consistency. We are way past the realm where it's viable for you to bring in a big box of everything you saved all for the year to your tax provider and have any hope of getting a best case income. And that doesn't mean that tax providers like ourselves and like others aren't going to do the very best they can, but it's like a giant game of Clue for us to try to figure out where everything ties together and how everything's linked together if it's brought in that kind of a format. So again, really, accuracy is what's going to put money in your pocket. And the person who can be most accurate with their bookkeeping is you. And the time that you can be the most accurate is each and every day at the end of the day. No, did you fill up the pickup with gas? Where's that receipt? Let's get it processed. Did the tractor come back from the shop, and were there repair bills that should be entered into the books? Let's get them in the books. Was today the day that the anhydrous ammonia was delivered? Let's get it into the books, right? And that's how we avoid this becoming an insurmountable year-end challenge. Understand that providers like MCR Accounting can only work with the data we're provided with, and the quality of that data makes a great deal of difference. So like a basic rule of thumb when it comes to this kind of bookkeeping, especially if you're talking forensic bookkeeping, and really even if we're just doing last year, but we're doing the whole year at once, I would still class that as forensic bookkeeping. And obviously, if we're doing 4 or 5 years at once, that's unarguably forensic bookkeeping. They will never maximize your return forensically. It's just, even forensically doing it yourself, you aren't going to be able to put the story together when you do it that way. Because remember what's going to happen if you're challenged. You're going to have to be able to produce legible quality receipts, and you're going to have to be able to defend the receipt. So with that being said, why don't we just get on and then start like we have been doing and take a look at the form itself. So here's where we're at with the statement of farming activities, the T-2042. Now, one of the things I want to say right off the top, the expectation, and non-farming folk might not realize this, but a lot of farms are multifaceted and have more than one type of a farming business. It is a recommendation at the very least, and CRA kind of asks for it, that if you have multiple types of farms, you would fill out multiple T-2042s, and there can be advantages to you to doing it that way too. Okay? So we're going to talk a little bit about the North American Industry Classification System, just like we did on the 2025, and for the exact same reason is people tend to be impatient here, and it is not in the taxpayer, the Canadian farmer's best interest to be impatient here. Don't just flip down through this list and pick the very first farm that you see. You want the activity defined here to be as absolutely close as possible to what you actually do. Because the algorithms that are going to look at these forms first, and eventually the assessment officer who's going to look at them again, this number is going to give them a database of benchmarks. And if it's the wrong database, and if it's the wrong benchmarks for what you actually do, you can see how that's going to cause them to call out things that maybe they wouldn't. So a certain expenditure for the type of business you actually do may be completely normal. But because you've put yourself in as a soybean farmer, and because the database benchmark is that soybean farmers actually don't have that expense at all, you see where this is going, right? So that's partly why I consistently refer to this as financial hygiene. The financial hygiene of looking after your receipts and records properly, that's, obvious hygiene, but the financial hygiene of taking the time, taking the care of providing the data to CRA as cleanly and factually and as close to the model they're expecting to see as you can absolutely get it. And your tax preparer is absolutely going to need your help on this, and it's all going to do with the level of record keeping you provide day in, day out throughout the year. Okay? So fiscal periods, most people run December to January, December, but it is not a requirement. Farms don't have to do that. So that's all that part is. We're not going to go a great deal into the identification, but I do want to talk about the business number. Because this is another place, and this will be true for those of you that I talked to on the 2025 as well. If you have a business number, otherwise known as your GST number in BC, or in provinces that have HST, it would be your HST number, then that number becomes very central to your financial health tax-wise, not income tax-wise, GST tax-wise, because of the way GST works for people who qualify for having a business number, right? And this is where absolute pristine hygiene and receipt handling can put a lot of money in your pocket. because the GST that you're paying out on the things that you're bringing in that are legitimate farm expenses, that GST you pay out can be subtracted from the GST you owe. But that GST is embedded in your individual receipts, and a great deal of it is embedded in your thermal receipts from gas stations and places like that. And you know, you might be saying to yourself, oh, I look at those all the time, they're $1.40 or they're 75 cents. When you bookkeep your receipts and you bookkeep that GST into a GST bucket, let's call it, you will find at the end of the year that there's a lot of money on the table. And your GST owing bill typically is quite accurate because it's based on your sales. It's really easy to capture. So if your GST owing bill is $27,000 and your patience, let's just say that your patience with receipt handling, you know, makes your financial hygiene in that area somewhat questionable, maybe you can only demonstrate $2,300 worth of GST paid out. Well, I would find that highly unlikely because with the numbers that we're talking about, I would think that the GST on your fuel alone should have been a great deal higher than that. Never mind all the other things. But I can tell you how that picture gets there. It's from not understanding how very important each little minor, seemingly minor step is along the way. Okay, so again, what am I talking about here? I'm talking about bookkeeping. If you're going to be a successful farmer in this country, you need to be doing basic bookkeeping. And yeah, it is unarguably a brilliant idea to also have an accountant. And maybe you want to contract out some portion of your bookkeeping, but as a farmer, a large portion of your bookkeeping you're going to have to do yourself if you actually want what's rightfully yours, if you want to be able to defend that. So let's move down. Now, nowadays there is farms that and this is the same as before. The government wants to know if we're doing business on the internet, if we're drawing business on the internet, that kind of thing. If you do, it cannot hurt. If your farm has an internet site, it cannot hurt to show it. Maybe someday they're going to start giving us some kind of credit for this thing. I don't know. So now we come down into the income section. So we're not going to talk a lot about the T-2042. That's partnership farms. That's quite a lot. That's getting into much bigger size farms than really the direction I was going with this. We're going to talk mostly about, multi-generational family farm type things. So there's not going to be any partnerships involved, right? Or there may or may not be. So we're going to skip over all these extra incomes. We've talked about all these various different things at various different times. On a 2042, because of the various programs we have in this country, you're going to see incomes from various different income protection plans and things like that as well. Okay, so this is self-explanatory. Like, I'm not going to go through it in absolute detail, but I do want to point out the level of detail that CRA requires. CRA does not want you to say, I sold some crop. CRA wants you to show what you sold and how much did you get for it, right? Not just sold some crop. And this goes back up to here where I was talking about this proper classification number. Say you've chosen hay farmer, right? Because you were scrolling through the list, it was really long, you were really bored, so you put yourself down as a hay farmer. And then, as a hay farmer, you're showing that you sold, $500,000 worth of wheat and $750,000 worth of oats and perhaps another $200,000 worth of canola. Well, those would be pretty unusual numbers for the benchmarks that are going to come up on the profile because you put yourself in as a hay farmer. Okay, just a way of pointing out that, you know, I emphasized at the top why we're going to put a great deal of time into making sure we class it right, but we absolutely have to, and you can see why it breaks down that way. Okay? You will not. So like I talked on some of the other forums about trying to make sure that, you know, you have claims for all the white boxes. Well, these farm forums are meant to cover a lot of different farms, and it's pretty unlikely that you're going to have stuff all the way down this line. Okay? So then you come into livestock. And one of the things I want to say about livestock is please remember when you're selling livestock, you are selling assets, right? And I'm going to talk just a little bit about it. It's way beyond the scope of this this particular video. But your livestock, as it's born, is increasing your inventory. And your livestock is inventory. And if there's a mistake I see, far too common, it's not putting the due diligence into livestock inventory. And here's the common one that I see. Generally, your tax preparer will catch the giant receipt that comes through for livestock that you purchase. So then that livestock will get inventoried in. But, you know, after calving season, presumably, if it's been a successful calving season, there are more cows than there were before calving season. This should become a part of that month-end review. Is your inventory now correct? So, you know, it's not as quite as simple as I laid it out there, but I want to get everybody thinking that way. Everything, every product that a farmer makes is part of his inventory. But it can only be properly book kept and managed as inventory if right from the start it is managed that way. So the rest of this is just going to be self-explanatory. We will point out things like, you know, lots of people keep bees. Lots of people sell honey. Bees and honey is a farming classification and has a home in this. So to the point that maybe you're not actually thinking of yourself as a farmer at all. You're a T4 earner, and your particular side hustle, as people like to call it nowadays, is a bunch of beehives. You take them around, you got some farmers that let you put them in their alfalfa field or whatever it is you do. Well, you should be filing on a 2042 for your side hustle. Right? Just like the person that's selling hair care products as a side hustle files on a 2025, right? So bees and honey are farming, and honey income is farm income and needs to be declared whether you're running a farm or whether you're doing it as a side hustle. That's what I'll say about that. I presume there's lots of similar things I could say about maple products, but I don't work in that part of Canada, and so I would be like me talking about fishing. Okay, subsidies, crop insurance, those program payments are part of your income. So understand that your crop insurance and your subsidy programs, they are expenses, and we'll get to that, and they're legitimately claimable, but when they pay out, they are income. Again, that income is going to be really obvious to your tax preparer because there's going to be receipts. But if you didn't properly capture the costs as well, you don't have anything to offset the level of tax penalty that's going to come out of this. If you're involved in the Western Grain Stabilization Program, I guarantee you know way more about it than I do. The same with the wheat board programs. There are rebates on both property taxes and gasoline for some types of farms and some types of activities. Those rebates have to be claimed. Insurance proceeds, you know, you bought crop insurance and sure as the hail did come and you did cash in on the crop insurance, but it's not like winning a lottery. It's part of your income now. patronage dividends for, I'm sure in this part of the world, I'm not sure if there are any actual farmers that are not co-op members. And if you're a co-op member and you're putting all your business through the co-op, then you are pretty well aware of what patronage dividends look like, because you'll be getting those on a T4A from your co-op account every year. Other incomes, again, if it's an income, they want to know about it. So just because they haven't mentioned it doesn't mean, right, that you don't need to mention it. Again, we are a self-assessed tax nation. We are expected to confess, as it will. We're not expecting people to come and hunt us down. We're expecting to be forthright. Okay? Now we get into the expenses, because this is where you make or break, right? Whether we're talking, this is a much longer list than the ones we've looked at so far, but whether we're talking about a 2042 or we're talking about a 2025 or we're talking about the much more specific costs on a 2200, nothing happens without accurate, permanent record keeping. And in this case, we are at a level that record keeping really needs to pick it up and be actual bookkeeping. Not just notes written on receipts, actual bookkeeping. Bring the receipt home, go into your office at the end of the day, bookkeep it out. I mean, successful small business people all over this country do this. This is an absolute foolproof model for financial hygiene success, and I know many people that do it this way, and I strongly advise that the daily method is the best method. Anyway, carrying on. You will see, and we're not going to go through these line by line, but for non-farmers, might not even be aware there are this many possible things. But every single thing that you're buying to pour into that farm, you need to be bookkeeping for, because all of it has two. I mean, as you can see, a lot of this is just plain deductible, and all of it you're paying GST on. All of that GST can help reduce your GST. There isn't really one aspect of this financial hygiene I'm pushing for on you that is the magic formula, and the rest is just, it's really all of it. We often say that in any good program, 80% of the gains come from good actualization of 20% of the program. That is not true when it comes to these types of tax issues. If you do 1%, you're going to realize 1%. If you want 100% of the claims that will help make you equal to that standard T4 earning Terry the taxpayer, then it isn't 20%, it isn't 80%, it's 100%, right? And again, it's not that big a deal if you do it every day, or at least do it weekly. It's not that big a deal. Feed supplements. Like, really take a good, long, hard look at this list, because there are things that people don't even realize, right? That they should be, containers and twine. Right? Farmers use vast amount of containers and twine, and you know what? They're tax deductible, right? So as we go through here, same thing. Machinery expenses. This is back to, we're gonna talk about autos, but this is not your car. This is not your farm truck. This is the rest of your machinery. So we're gonna handle it here, but we're going to handle it the same way, that same hygiene with those thermal receipts, et cetera, et cetera, et cetera. Now, the gasoline, diesel oil, fuel, most farmers have bulk delivery of some sort, so it ends up not being that difficult to capture that part. But if you ran down the road, you broke the drawbar on the tractor, and you're out in the field, and you threw it in the truck, and you ran into town, you got it welded up, and you came back, at the end of that day, you probably remember having that break in your day. That's why I'm saying now is the time to put it in the books, right? because that cost will get lost. And yeah, Pete, it's only $100. It's not like it's going to save me. No, that $100 won't save you. But the sum of all of this that we're looking at, it will save you. Building repairs and maintenance, including fence repairs. Now, livestock farmers in particular seem to always be doing fence repair. And those costs, let's just say that in my experience, people could do a far better job of capturing their fencing costs. And if they did, they would have GST offsets for their GST owing, and they would have deductions from their total earnings. So again, clearing and leveling land. You know, a lot of times people think that's just on them, and certainly the hard work of clearing and leveling land is on you, but the cost, the massive amount of fuel that you use, you maybe even hired people to come in and help you with it. Those things have to be captured. You maybe had a bad year. Maybe you're a barley farmer and you ended up having to run virtually everything that came off the field through the grain dryer this year. Well, on that year, you're going to have very high fuel costs. Okay. Feed, supplements, straw, and bedding. I wanted to stop there, so I'm going back to that. Understand, well, how is the best way to word this? If you're a rancher and you put up your own hay, and maybe even put up a little bit of grain, is part of your overall ranch plan, that you'll be self-sustaining on livestock feed, but you have a bad year, then suddenly you have a big claim here that CRA is never used to seeing on your forms before. And the only reason that this is going to be completely outstanding is because you didn't or haven't been documenting your forage production on your normal years, which is a long way of saying when you take the hay off, you should inventory it. Not saying there's going to be huge amounts of money in it for you, but it's going to show how much hay, and then you can bookkeep that hay as you feed it to the cows. That shows, it builds a history. It shows what that herd consumes, and they consume it every year. But this year, we had, let's say, an unseasonable winter, and you lost 99% of the crop. That livestock is going to need the exact same amount of feed it ever does, and that means that to survive, you're going to have to purchase it. And there's going to be a huge number here. That number should be naturally offset by your bookkeeping year on year in the past. It should not come up as a surprise. It should be easy to defend. But if you've never been bookkeeping the fodder that you produce for yourself, this number can really be an out of the blue type number. So I'm just using that as an example to try to get people thinking in terms of how much precision is necessary to protect yourself. And let's not even play games around this. This is not something any of us are doing for the government. This is not something we're doing to please Ottawa. This is to protect ourselves, to preserve our rights as Canadian workers and taxpayers. That's what it's about. That's why I'm looking for personal involvement on these things. Custom and contract work. Now, a lot of people are getting into that these days, and maybe you got like super good equipment, and maybe you do custom combining for all the neighbors in the neighborhood, or maybe you got super good haying equipment and you do custom haying. Those are incomes that you would have as an earning if that was you, and you would have as an expense, right? Maybe your combine broke down at the beginning of the year. So again, this might be an expense you don't normally have, right? But now all of a sudden you do. office, telephone, all these costs. So before we talk about putting costs in here, office advertising, office expenses, you can do this. And maybe, you know, in the case, let's say you were doing a 2042 because you had those beehives and it was all about, you know, 3,000 pounds of honey that you sell every year. Perhaps you would do that this way. But if you're a full-fledged rancher or a grain farm, then I'm recommending that we're going to actually have a home office, right? Where is it? Where is our home office, right? And this is going to work the same as it did when we talked about the 2025, right? So we're going to know the size of our home, we're going to know the size of our office, we're going to calculate it out. Then in here we're going to put all of the bills. Not the bills for our office, all of the bills for the home that the office is in. All of our heating bills, electrical bills, insurance, maintenance, mortgage, interest. You know, I got to keep calling this out. It's probably just that we're all a bit sloppy with the way we talk. But in Canada, we do not have a claim for our mortgage. I hear people say it all the time. Oh, I get a mortgage claim because I do so-and-so. And you know what? You don't. And you shouldn't really say that to people. It's misleading. You have a claim for certain types of businesses on your mortgage interest, a portion of your mortgage interest. So what you need to provide your tax provider is not your mortgage payment. On your annual mortgage statement, it tells you what the interest paid last year was. That's the number that goes here. You could have some other expenses like related to the home. I'm not to the home office. I'm not really sure what they would be, but you do have an opportunity to specify it. Again, like I've warned with every other one of these T forms, if it's not one of these things that the government already recognizes, then be very precise in what you write in here or what you ask your tax provider to write in here. Because the imprecision just really irritates the CRA, and it makes them want to look deeper and deeper and deeper and deeper and deeper. And by now, if you've been following this T series, you're getting the idea that, geez, if they really look deep enough, then is anybody ever pristine enough on their financial hygiene? And I don't have the answer to that. All I can advise you is the cleaner you do it, the easier it's going to go for you. Okay? So we're not going to talk about the partnership businesses and stuff because remember, this is the family farm, but we are going to go on to the autos now. So now this is not a grain truck, it's not your combine, it's not your tractors, it's not, you know, whatever other kinds of machinery you have on the farm. You're going to deal with that on your 2048. But your actual motor vehicles, and I would think on most farms there's going to be multiple vehicles that should be in here, right? Because it is in your best interest to register all of your vehicles, and that way, when for whatever reason you're doing business in a vehicle that you didn't think you would do business in, you will still have some amount to claim for it. Because what happens is if you think, well, I'm only going to use my 1968 F250, that truck is going to be everything I'm going to do. The good car is the wife's car, and I don't ever do farming business in the wife's car. You know, you will, because I've seen it a million times, so I'm promising you will. And here's the problem. When you just try to slip those expenses for that other vehicle into this vehicle, unless they were identical vehicles, it's going to be obvious. Right? It's going to be obvious to the algorithm. And once it's obvious to the algorithm, then somebody's going to be looking at it, right? Because the algorithms are fast as lightning, and if they've been told to look for something, they don't ever miss. So, Put in your vehicles. It doesn't take that long, or bring them to me. Bring the data. We should, these things, and especially you are farming for a living. So basically, anything you buy, you should be looking at claiming capital cost on. And you can only do that if you're bookkeeping everything properly. You need to bring it all in to your tax preparer in a way that it can be used. So again, we're going back to looking at just what we need to have. We need to know the make, we need to know the model, we need to know the year. When did you buy it, right? If you dispose of it this year, we're going to want to know about that too, right? Is it a partnership vehicle? Where no, it's not, because we're not talking about partnerships. So right here is where everything sorts out. So this F-250 that we speculated about, maybe you might drive 200,000 kilometers in the fiscal period, and as a part of doing farming business with that truck, you drove 197 of those 1,000 kilometers, right? So that's going to be an over 90%. This vehicle will actually then end up being claimed as a 100% vehicle because you're well over 90%. And if it stays well over 90% year on year, it becomes kind of locked in as a 100% vehicle. Over here, on the other hand, is, you bought your wife a Toyota Corolla. You didn't think you'd ever use it, but you took my advice, so you put it all in here, and if nothing else, you're getting some manner of CCA claim. But it turned out that you had to go to an auction, a farm auction in Saskatchewan, and you used the Civic because, basically the 1969 F-250 wasn't giving you a lot of confidence that it would make it all the way there. Now you're glad that you have the wife's vehicle registered in here, right? Because now you're going to be able to, those several thousand kilometers are going to go in here, and it's going to generate a percentage, and then we're going to put in all the costs on your wife's vehicle, and yeah, you're not going to get a claim on all of them, but you're going to get that percentage, just like you're going to get the percentage on this one. Okay, so that's a little bit of an elaboration. All of these auto forms, as I said, way back at the 2200, are the same in terms of what you have to do. Again, I'm going to tell you, there is no such thing as an automobile expense unless there is an automobile logbook. So please, please, please put a logbook in each of these vehicles. And don't put it in the glove box, because then you'll forget it's there. Put it somewhere annoyingly in your face, right? So that you remember it's there. This vehicle here, that once you've proven that you're over 90%, the logbook's going to slowly not become less of an issue here. This other vehicle that you're maybe only doing 8 or 10% a year, that logbook is going to be critical forever. And logbooks are not as difficult to use as people like to make out that they are. Okay. So again, I'll say this, I've said this on a couple of these, when we're looking for your expenses, the tool, the 2042 auto tool, is going to calculate the allowable expense for us. So this is something that, people trying to do the right thing can often damage their own case, or at least limit the amount of their claim. So don't try to figure out how much gasoline you burnt for business. Give me all the gasoline that number 1 vehicle burned, all the gasoline that number 2 vehicle burned, all the gasoline that number 3 vehicle burned. And I'm going to say this about gasoline receipts again. They're almost always thermals, and it's really obvious if you got 3 receipts in a row for 120 liter, and then 1 for 50 liter, and then 3 more for 118, and another one for 45, it's really obvious that you are mixing receipts from another vehicle in there. But you're not going to do that because you took my advice and you filled out all of these. So you're going to put the receipts that go with vehicle 2 that only takes 45 liters of fuel with vehicle 2. Another reason why you're going to fill both of these out. Okay? License and registration, insurance, maintenance and repairs. Leasing costs, if you're leasing your vehicle, you're going to do it down below. I'm just going to quickly say that if you're one of the people that over the years has constantly been bombarded with the falsehood that if you lease a vehicle, it's like magic and the CRA will leave you alone and they'll never question your expenses, I went into that in some detail in the 2025. I'm not even going to bother anymore. It's just complete bullshit. Just being frank with you. The people telling you that are pulling it out of their arse. So you can lease if you want. There's nothing wrong with leasing, and leasing's becoming a bit more and more of a viable option than before. But what you're allowed to claim is no different than if you bought the vehicle. Just the way you calculate it's different. Okay? And you, of course, on a lease, CCA is a totally different question. Oh, let's get back over here. The eligible interest section, I'm just going to touch on it. This is not a real big thing right now, but it sure was back in the late 80s. Let me tell you, when interest rates were 19.75%, the CRA wasn't necessarily agreeing that you needed the vehicle bad enough to pay that kind of interest. Eligible leasing costs and eligible costs for vehicles. This 30 grand, you're going to see this coming up. It's going to restrict your CCA allowance. It's going to restrict your leasing costs. It's an old, outdated number. Just being upfront with you, the CRA decided, I don't even know when, that for any kind of work, and this includes you running a farm, just as it included the 2025 businesses and the commission sales businesses, it doesn't matter. The CRA decided, and they have dug in on it, and they don't seem to be all that willing to change on it, that any vehicle that costs more than $30,000 is a luxury extravagance and therefore not tax deductible on the portion above $30,000. Well, of course, you can't even really buy a workable used pickup truck for $30,000. We all know that. We all know it's a joke. We all hate it. That being said, there's nothing that you and I can do about it. I don't know. I mean, certainly we're not hearing anything in seminars and stuff that tells us that CRA is any closer to changing this. Every tax professional in the country has been badgering CRA for years on this. It is a running joke in our community, the $30,000 vehicle thing. Just know that it's true, but don't let it discourage you. Because CCA, capital cost allowance, on $30,000 is a lot better than capital cost allowance on nothing. Admittedly, I know your pickup truck costs, $90,000, and I know that CRA is ripping you off for 60 grand there. I get that. But the rebellion isn't to not participate. That just puts more money in their pocket and less money in your pocket. So I think that's about covered what I wanted to cover in terms of where we're going with this thing. If we switch back to the other camera. Again, there's no magic, and I wish there was. And I wish there was easy, simple, breezy things that I could tell people that you could just live in a relaxed way, and at the end of the year, your tax preparer would magically get you everything that's due to you. But that's not how it works, as is apparent if you've been following these T-series. It all starts with you, and it's all about financial hygiene. And financial hygiene can be a nasty, nasty undertaking if you're staring at a banker box with a year's worth of farm activity in it. But as I've said throughout today's video, if you're looking at these things as just part of your daily routine, just part of your job as a farmer or as a small business person, that at the end of the day you close out by bookkeeping your day, then this all becomes far, far easier to work with. And what you are bringing to your tax preparer is making it easier and easier, not just to maximize your claim, but to potentially reduce as well the amount that your actual tax filing costs. Because None of us can spend 5 or 6 hours bookkeeping a client's file and not charge back for that. And the work that we do in that 5 or 6 hours bookkeeping your file is never ever going to be as accurate as the work you would do if you book kept your farm or your business, or if we're only just talking about your vehicle, you're on a 2200 T-2200. You're one of those people that you would have had a company vehicle in the past, but now you're expected to provide your own vehicle for company purposes. Again, bookkeep it daily, and it'll make your life way easier. And ease isn't even really what it's about. What it's really all about is getting back what's due. These are much more difficult ways to make a living than to be a T4 earner. Let's not make any bones about that. T4 earners with pension plans and payroll savings plans and source deducted taxes seldom get themselves in a large amount of tax difficulty. But it is exceedingly easy and exceedingly quick for self-employed individuals to get themselves in a whole lot of tax difficulty due to things like interest and penalties. And going forward, now that I'm finished the Big T series, I'm going to do a bunch of shorter videos talking about some of those things. So I don't want to spoil that. Thanks for coming by. All of these all the MCR accounting financial literacy videos are archived and available at our website, mcraccounting.ca. All one word, all small letters, mcraccounting.ca. You'll find a tab at the top for financial literacy series. You click it and the menu comes up at the bottom of the page. And you'll find each of these videos in there, as well as videos that we've put up in the past, and all future videos will go in there too. So thanks a lot. I hope this has been useful to some people. There's not a much more difficult way to make a living in this country or any other country than to farm. And it's important that those farms that keep us all going are given their proper rights under the tax code. So have a good day. Thanks a lot.